Markets moved higher today while gold slipped as the U.S. dollar strengthened. Here at home, TD Bank beat estimates, but also said it's going to cut 2% of its workforce. Let's go to Garnet Anderson. He's Vice President, Head of Portfolio Management at Tacita Capital. Thanks for coming in.
Thank you for having me.
So TD beat on revenue by quite a bit, but then announced also that it's going to slash its workforce. I'm wondering if you see other banks having to follow suit, or is TD in that unique position because of what happened to it with the U.S.?
Well, I think that's a strong part because they're saying, look, we have these additional AML costs coming out of the episodes down stateside, and so they're counterbalancing that. But they also mentioned they're investing in AI efficiencies, and every other bank's going to be doing that. And particularly, you take a look at Royal or even National now with their acquisitions, CWB for National and HSBC, that Royal's still digesting and chewing through. So obviously, they're looking for efficiencies, trying to take advantage of their scale. So I think it's just been a continued theme throughout the banks. They have to get efficiencies.
Okay, TD Bank, and we just want to remind people, got dinged with a $3.1 or $2 billion penalty for not flagging sort of money laundering situations.
Exactly, and you know, they sold Charles Schwab. We've got to reduce their loan book, and so they're working through that as well. So it's, you know, it's not something you can turn the page on overnight, but certainly they've had changes in management, and you can see where they're focused on the issue ahead of them so that they put it behind them.
Okay, so of the banks, and we're starting to see the earnings come in just with TD, who do you like?
Well, when we take a look at our value quality momentum pool within our quality section, we have Royal. We have a couple of the banks, but Royal would be really our top holding. And the reason for that, first of all, you know, a little bit of stability on the downside. They have a great tendency of kind of consistent earnings without really many surprises. They did have one last quarter, though, in terms of a large single entity loan provision. So I think the market's right now kind of going, well, that's it, right? There's no more coming down the pipeline. And so I think we'll see on the 29th that it would be a surprise to the market if there was another big loss. So if they can rein in, just like TD, rein in their provisions for non-performing loans and for performing loans, show some progress there. And that's not an easy ask because you go back a month ago when everybody's loan loss provision estimates were going up.
That's what I was going to say.
And then retreating back, and then what, in July.
Is that what they should be doing right now, considering we aren't sort of facing that stark drop-off that we thought we would only a month ago? I
think they can only deal with the cards that they have at hand. What really goes on to transpire after the 90 days, what goes on with Canada, what USMCA down the road, what goes on with China. I think the banks, in fairness to them, they can't read Trump and co.'s mind as to actually where this will come to rest. All they can do is look, what's my non-performing loans? What's the provisions I need against there? I'm looking at my economic models. I'm looking at the downside. And what provisions should I take against performing loans as a cushion against what's coming down the pipeline, i.e. the future? So, you know, if they keep it, I'll say, relatively modest, I think the market will go, okay, great, that makes sense. Do they continue to make decent profit or spread on their net interest? So between what their cost of capital, so deposits and so on and so forth, versus what they're lending out at, fine. Loan growth, they've highlighted before, and the other banks have highlighted this before. When you have corporations and individuals sitting on their hands because of the uncertainty out there, growing your loan book is not an easy task. And so that should be a little bit of a headwind. And honestly, can't blame business owners right now for when, where am I building? Who am I hiring?
Yeah.
And households, why am I buying a house? I don't know what my job situation is going to be.
Next month.
Yeah. So mortgage slow down a little bit, so on and so forth. And kind of the counterbalance is in times of volatility, often you get more trading activity, so their capital markets area, you know, should show relatively plump numbers, as TD did today.
Okay, let's talk about gold for a moment as well. We had record highs. I'm just wondering sort of where you're looking at with that. It's been on and off sort of the past week or so after reaching those record highs.
Well, exactly. So within our portfolios for our clients, we've always had kind of an allocation to bullion. And so that has played out quite nicely. And you can take a look at supply, demand, and foreign governments buying, and you know, in fear that the U.S. weaponized global payment system after Russia went into Ukraine. And so there's some just reasons for that. Every party ends, but at this stage there doesn't seem to be a slowing down on that front. So people can go into bullion, but where people have started to attract some of their attention, and we see that, we pick that up in our momentum sleeve, is going to gold stocks. So first we saw the more senior gold stocks start to move and have fantastic runs. So it got to the point where every time, you know, gold was up 1%, the senior stocks were up 2%. And it didn't take long for the, you know, small, medium-sized players to come along. And why? if they're able to sell gold at, $3,000 an ounce, and their cost, for example, let's take Kinross, somewhere between $1,500 and $1,800 per ounce in terms of their cost. Obviously, their margins are great, and it's a commodity. It's cyclical. So what do they do with that cash? Pay down some debt, which makes sense. You have to reinvest into your properties. That makes sense. But they're not going out and blowing it. In particular, back in the days, be it oil, be it gold, it'd be just, I have to go on an exploration hunt and start punching more holes into the ground. There's a little bit more restraint now in both the energy and the gold mining patch.
I want to ask you about diversification as well. And I mean outside of North America, because there was a lot of talk about that, of course, when the tariffs came in and the U.S. market got squashed and people are like, let's look at Europe, it's doing really well, let's look at Japan. Where are you landing on that these days?
Well, it's interesting, actually. You start to see, and not just us, making sure there was an emphasis on IFI, or international developed markets. And that really started about 5-6 months ago. Despite the tariffs and despite the other thing, but they start to show some signs. Germany was going to loosen the purse strings a little bit in terms of their budget deficit, strike some economic activity. And then Japan, it's better than it was 5 years ago and 3 years ago, and it doesn't look like it's been a false start. The Japanese market had so many false starts over the last 20 years. This one looks like it's kind of taking root a little bit.
Okay.
So you've seen that redeployment of somewhat of capital, particularly as the U.S. market got A, concentrated, and B, super expensive. Now, when you take a look at the valuation levels, both in emerging markets and in international developed, you go, oh, goodness gracious, they are inexpensive relative to the U.S. But they are traditionally inexpensive compared to the U.S. The U.S. have great return on asset numbers, return on equity numbers, good quality, high margin companies, global. You don't have exactly the same presence in those markets. So they were still advantageous, good yields, decent valuations. But they were not dirt cheap. But there has been that rotation.
Okay, so we do have to leave it there. I'm out of time with you, Garnet, but thanks for coming in. Appreciate your time on this.
Thank you.
Garnet Anderson is Vice President and Head of Portfolio Management at Tacita Capital.